morning and welcome back to the Daily Moo. I'm Slim Kanat, guiding you through the latest in financial markets. So let's get into it. US markets were mixed overnight. The Nasdaq Composite slipped 0.26% while the Dow jumped to a new record. That shows us investors continue to move into more defensive stocks, away from tech in particular. Now, big names were under pressure. Oracle fell 4%, Meta dropped 3%, and both Amazon and Tesla lost around 2%. It's part of a wider pullback from high growth, high risk names as investors look for safer ground. But let's note, Hong Kong continues to rise this month, with the Hang Seng up 0.86% yesterday. Its biggest stock, Tencent, will report today. In Australia, all eyes are on the unemployment data due out today. Economists expect a small uptick, which could signal that the jobs market is cooling. It'll be a key factor for what the RBA does next on interest rates. Now, let's focus on what investors are doing as they rotate out of risky areas. In recent updates, we've covered the defensive and healthcare stocks they're turning into. Now, let's consider the exchange-traded funds that are finding favor as investors shift to safety. While tech stocks wobble, we're seeing investors rotate towards defensive ETFs, in particular, broad market funds that spread risk across sectors and regions. In particular, we're seeing strong inflows into Vanguard VAS, Australian Shares, VOO Vanguard S&P 500 ETF, and VGS Vanguard International Shares ETF. Now, what this tells us is that investors are favoring stability over speculation. And why? Because they're facing renewed US-China trade tensions, a US government shutdown, uncertainty over the direction of interest rates, combined with strong earning results from US companies, but continuing questions over the ultimate returns of the huge investments into AI. Now, all this means global risk assets have experienced significant volatility, and so investors have swung into broad-based ETFs. So let's run through the three most popular and see what they offer. VAS, the Vanguard Australian Shares ETF, tracks the ASX 300 and offers solid dividend exposure. It's a favorite among local income seekers. This year, it's up 8.6%, holding fairly steady since August. It matches the ASX 300 with most exposure to financial services, resources, and consumer stocks. Now, VOO, the Vanguard S&P 500 ETF, is the benchmark for the US market exposure. Simple, low cost, and diversified, it gains 16% year to date, with more than a third of the fund focused on tech, balanced by finance, consumers, and communication stocks. It's one of the most popular ETFs in the world. Now, VGS, the Vanguard International Shares ETF, gives access to developed markets worldwide, providing a global safety net for portfolios. A very diversified fund, it's up 11% this year. Because of the size of the US market, the VGS is mostly exposed to that region, with Japan, Britain, and Canada among its next biggest stakes. Now, in an environment where uncertainty lingers, from interest rates to tech valuations, these ETFs represent a quiet move towards reliability. Investors aren't exiting the market, they're just grazing into safer pastures. Now, let's run through today's watch list with three stocks worth keeping an eye on today. First up, we've got Southwest Airlines. The stock climbed 4.2% overnight and is up 9% over the past 3 months. Along with other US airlines, it faces a big cost from the US government shutdown. Its rebound is over news that is about to end. In addition to that, the airline are expecting a stronger last quarter of the year, and we're seeing the price of oil drop, which is a further boom as jet fuel is a huge cost for airlines. While the stock has a hold consensus among analysts, as we can see on the Moomoo platform, it could be set for further growth. Now, moving on to Cisco, a standout performer after hours this morning. Cisco jumped more than 8% on stronger than expected earnings and revenue. The company also raised its forecast for its current quarter, driven by surging demand for AI infrastructure, the backbone of data centers powering AI. Analysts mark Cisco a buy, highlighting it a steadier way to play the AI boom compared to more volatile tech names. And finally, Life360. A tougher story here. Its shares fell 13% yesterday after disappointing user growth data was revealed. The stock is now down 25% in a month, though it's still up 79% for the year. But analysts continue to rate it as a buy rating, so its current weakness may be a potential buying opportunity. What could help it along is the new pet tracking device, which the CEO says will help it convert millions of users into paying customers and attract young adults. And that's your daily move for today, your scoop on markets and investments. I'm Slim Kanat, and thank you very much for joining. Cheers.